Good morning, good afternoon, and good evening, and apologies for the technical issues. I hope we managed to fix them. Thank you very much for attending today's Refinitiv and MATHWORKS webinar, Managing the Diversification of ESG Portfolios with Lagrange Multipliers. Before we begin, let's cover a few housekeeping items. We will be recording today's session. At the bottom of your screen, you may find multiple widgets for you to use. All are resizable and movable, so feel free to move them around to get the most of your screen space. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try to answer these during the session, but if we run out of time, they will be answered later via email. Please know we do capture all the questions. We will be using interactive polling during today's session, so please do participate. Additional materials are available in the resource list. Please download those you may find useful. You can find out more about our speakers via the speakers bio widget. For the best viewing experience, we recommend closing any programs or browser sessions running in the background. This will help conserve your bandwidth. The webcast is being streamed through your computer, so for the best audio quality, please make sure your computer, speakers, or headset volume is turned up. Some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. If your slides are not progressing, pushing F5 on your keyboard, Command plus R for Mac, will refresh the page. We value your feedback, so please do complete the pop-up survey at the end of the webcast. An on-demand version of this webcast, including the slides, will be shared on Friday, October 23rd, and also be can access using the same audience link that was sent to you today. So let's kick off, let's start. I'm happy to introduce our speakers, Valerio Sperandeo, Senior Application Engineer, Financial Modeling at MATHWORKS, and our own Barnabas Axe, Global Business Development Director, Sustainable Finance at Refinitiv. Bernie, over to you.
Hello, everybody. It's a pleasure to be here, and I'm looking forward to the session with you. I appreciate that we had some delay in starting, so I will try to push my things forward a little bit quicker pace than originally planned so that you can fully enjoy Valerio's presentation. And happy to, of course, address any questions you may have towards the end in the Q&A session. Just continuing on, what we were thinking would be a good idea is just to put it out there for you and have a quick question to gauge your experience, knowledge in regards of ESG integration. So the question is, have you integrated ESG data into your portfolio creation process before? If you could just click one of these so that we can see a quick statistic, that would be providing quite some insights for us. Moving on. Okay, very interesting. So Valerio, a very good scope for you to discuss a few things today. Moving on to my set of introductory slides. So what I wanted to bring to you is a little introduction to the ESG data and analytics landscape, and just a little insights into how we at Refinitiv do approach this this problem, this challenge, what the firm is increasingly facing nowadays in this day of age. And if I think about ESG as a data set and a set of analytics and ratings, we could say that the 360 view of ESG would compose of three things. So when you do ESG integration, you do have to have at least one of these sets. So either you would have to have a kind of a formula-based rating system that is basically based on the company reported information, which is then clearly and transparently transferred into a set of ESG-related ratings, and then eventually that will culminate into one rating on the top. Or you would have to have some kind of natural language processing tool which allows you to basically do a sentiment analysis on the news and social media sources that you are interested in, and that would provide you a similar set of rating. Of course, the ingoing data will be different, so the results are going to be different as well, but that's another view. The third view, and maybe up until now, one of the most common views or sources was the discretionary research based rating, which is, part of company reported data, part of a set of formulae, and part of some discretionary proprietary decision made on the rating methodology. And the result is again a rating at the end with maybe less of underlying data metrics. Of course, every of these have their pros and of cons with them. We of course have focused our attention at Refinitiv on the formula-based rating. We are developing strongly to our existing proposition on the ESG sentiment, and of course in our research database we have third-party researchers who we provide as a sort of a benchmarking on dimensional tool set. The foundations of our USPs are basically set on two things. One is the objective methodology that I have mentioned earlier, and the other one is the technology-enabled data, which is basically a wide range of data on one individual company across 52 industry groups, and looking back to history in quite many cases back to 2002. And this kind of combination of data and methodology is basically giving or providing a ESG glass box. And why we think this ESG glass box is a unique solution to ESG challenges, because if you think about it, the integration methodology of ESG has been changing rapidly over the last couple of decades. At the very outset, it was heavily based on negative screening criteria. From the turn of the century up until about 2015, it was much more around ESG overlay, which is basically having a portfolio ready and getting a off-the-shelf solution that would sort of make sure that you don't have any ESG red flags in your portfolio. And with the increasing nature of big data and more reporting and more transparency around ESG, and of course the regulatory push, ESG has become a factor in the last few years. So not only the ratings, but the underlying data sets are actually carrying quite a lot of information about the mitigation, or to mitigate risk, or to actually generate alpha. So the click-through capabilities, the exposure metrics, the managing of those exposure metrics are having increasingly big amount of value. And of course, it's also important to understand that it's important to have a quite wide range of data, and it's also important to have a replicable, tailorable methodology that is clearly explaining the weight and the role of each metric within that ESG rating pyramid. So how do we go from a quite wide range of data about a company? How do we assess the transparency of the data sets? How do we go from that 450 plus to 186 that are finally included in the rating mechanism? And of course, get from different categories through to the pillars, then to the ESG score itself. How do we overlay the controversies that are happening around the company, which is negative news, and how do we get to the ESG combined score? So when you have this, the more transparency this process is, the better it might be for quantitative approaches while we are actually here today. I wouldn't spend too much time on this structure. Basically, it shows the bottom-up aggregation and the travel from the very raw data to the end ESG score. And it also shows you one important thing that I want to highlight here is on the right-hand side is the handling of materiality, which is a very important buzzword in the industry at the moment. And us having a quantified approach to it and a quantified weight to it that we transparently disclose in our methodology documents is also enabling our clients to basically tailor materiality according to their needs, should they be different from ours. The other important aspect, of course, and I will hand over after that to Valerio, that the ESG data set that we are talking about is integrated into our QA workflow. So he will going to mention the QAD platform. We, of course, have quite numerous data sets integrated in that platform, and one of them is ESG, alongside fundamental data, estimates data, pricing data, etc., etc. So all these, with the methodology and the data, should be providing you a quite good foundation to start integrating ESG into your portfolio creation processes. And with that, Valerio, over to you.
Yeah, thank you, Barnabas. And hello, everyone. My name is Valerio Sperandeo. I work with MATHWORKS since 3.5 years as an application engineer, mainly supporting our users in developing and deploying financial application. The demo that I will show you today, it's mainly referring to the way you can actually incorporate ESG information into your portfolio construction process. Oftentimes, and also from conversation we have with some of our users, simply excluding assets which have a low ESG score is not a very desired thing to do, and for many reasons. One might be that your portfolio can increase in terms of tracking error if you are tracking a market index, for example. You can, simply excluding ESG assets, you can increase the concentration of your portfolio. And oftentimes it happens also that you may end up investing in assets that are correlated with those that you have been excluding before by taking into account ESG criteria. So the approach that I will follow today is I will access data, market and ESG data directly from QA Direct. QA Direct, as Barnabas introduced, is a cloud database offered by Refinitiv, which contains a large and a very rich list of data sets from market data to fundamental data, ESG data, and so on. I'm going to retrieve market and ESG data that relate to constituents of the market index FTSE 350. And then I'm going to show you some mathematical techniques, optimization techniques on how you can build a portfolio that is going to, on one hand, improve the diversification of a portfolio, as well as improve the overall ESG score of your portfolio. I'm going to show you different models. I will start from the classical mean variance model, the Markowitz model, that is maybe the most commonly used in the industry. I will start from that one, and then I will show you how you can make use, for example, of penalty terms in the objective function to increase diversification and the ESG score of the portfolio itself. Last but not least, I will take the models that I have built. I will introduce you a new feature that we have added in the MATLAB Financial Toolbox in the release 20B. It's the backtest engine. So I'm going to take, in particular, 5 portfolio models that I'm going to build, and I'm going to backtest over a given period. So this is going to be the end result. We are going to have a nice and tidy live script. It is an executable notebook from which you can directly interact. You can interact with live controls. As you see here, I'm using drop-down menus to define the start date, as well as the mnemonic of the market index on which you want to run your analysis, or on which you want to build your portfolio, and then the ESG criteria. And I will show you that directly selecting these parameters here, or in particularly the ESG score here, Matlab will directly speak to QA Direct, Refinitiv's cloud database, and retrieve interactively the data that you are selecting. So as you see here, equity prices is the variable that is going to contain the price times shares of all the constituents of the FTSE 350 index. And then the variable index ESG will contain for each of these constituents the L overall score, the ESG score that is contained in the database, as well as the ESG rating. So this ESG rating is I've applied simply the scoring, the rating methodology that is proposed by Refinitiv. Of course, then you can apply your own rating methodology. And as you see, this notebook is contains a lot of description. So you can add, for example, formulae. You can add description, titles, and you can make your work very interactive, especially then when you're going to share with another person, another Matlab user, the work that you have been doing in here. In the live editor, in this notebook, you can also visualize final results. And here, the results, the allocations of the 5 portfolio models, starting with the simple mean variance model, and then going on with the other portfolio models that I will introduce you later on. Last but not least, a summary with the backtest results. So you will have for each of the 5 portfolio models that I'm going to show you, you will have a series of statistics such as the Sharpe ratio, volatility, the turnover, the trading costs that you have incurred by selecting that particular investment strategy, and the same backtest, you can also, the results of the backtest, you can also then, obviously visualize them with a Matlab plot. In order to retrieve data from a cloud database, I'm going to show you that in Matlab there is available a particular tool called Database Explorer. This is a particular application that you can use, especially if you're not very familiar with database language, or if you have never been writing queries before. In essence, Database Explorer allows you to directly speak to the cloud database in a very interactive way. So, for example, if you're going to look for a particular market index, you see here on the left-hand side of the application, you see the list of tables. All those tables here in this particular case that start with DS2 are data stream tables. So you will find there market data of a long list of market indices. The list of indices are contained in the table DS2 index list. And if I directly go in there and tick the variables that I actually want to retrieve, you will see that interactively and automatically an SQL query will be generated up here without actually, this is done automatically by the application. And as well as a preview will be displayed here. So from this table, I've selected the 2 variables, index list desk, which is the description of the index, as well as the mnemonic. The application allows you also to do typical database operations such as join and where statements. So let's say we want to actually filter now from this list the entry that corresponds to the index, FTSE 350. So I remember that the mnemonic of this index is L FTSE 350. If I now add this filter, you will see in the data preview that the data will be actually filtered. Now, continuing like this, you can, of course, start now looking at constituents data. So now for the FTSE 350, we perform a join operation. And we are going to look for constituents data that refer to that index. In that case, I know already that the corresponding table is called DS2 const MTH. So I'm going to look for that one. So DS2 constituent monthly. And the merging variable, I can select it up here, again, very interactively from this drop-down menu. Once I click on Add Join, the join will be performed. And you see now the list that is displayed in the data preview is actually much longer, because now actually we have data for each of the constituents of the FTSE 350. If we look more in detail of this table, we have information, yes, related to constituents of this index, but not actually not yet the data that interests us. And in particular, the one that interests us is, of course, the constituent name, as well as the close price, for example, and the market date. So actually, the date observation for each of the closing price. I can go on doing performing joins. In this case, I am going to look at another table that is containing the constituent names. This table is called DS2 country QT info. So let's look for that one. Yeah, here it is. In this case, the merging variable is going to be the info code. And of course, for all this schema and for the correct merging variable that you will need to use, I refer to Refinitiv database schema. If I now look up for that table that I've just joined, again, I can select one of more of the variables that are contained in this table. What interests me is particularly the constituent name. And here they are. So now we have added to our table column, a variable containing the names of all the constituents. Now, for each of these constituents, I'm going to add market prices. So I'm going to look for another table. I will perform an additional join operation. And in this case, the table is called DS2 Prim QT PRC. Just like before, we look into the tables that start with DS2, because those are the data sets that are contained in data stream. So we are looking at market data. And here it is. Again, in this case, I'm going to merge by the variable info code. So we have added now three join operations with different data sets that are coming from this database. And you see how easy it is and how quickly the SQL query is being generated and automatically updated. Now, from this last table, I'm going to show you how you can select market prices. So first thing is to retrieve the market date. I just tick this box here on the left-hand side, as well as the close price. And you might have noticed that following this workflow, we didn't really need to know anything about databases. We simply had to select from data sets that are contained in QA Direct the corresponding data. So another nice feature is that after having done all this work in the Database Explorer, you can directly import the data from which you see the preview here, but you can also generate automatically the SQL query. So you will get an SQL file that you can reuse in your management application, database management applications, as well as generating automatically Matlab code. So if I click on that option, what is going to happen is Matlab is going to automatically the code that you see here. So we can now save this file. We can use it as a function. This is exactly the query that is retrieving market data. The connection with the database is being established by the function called database, and then ultimately the data is actually being retrieved with the function fetch. Now, another thing that I want to point you to is that we could have continued now to work in this environment to also make merge and retrieve ESG data. The way I've done it, you have to refer in QAD to all data sets and all tables that start with A4. These are all tables containing ESG data. And particularly the data that I'm going to use are environmental factors, as well as the corporate governance factors, as well as social factors. Or you can also use the overall ESG score. So a score that contains information around environment, corporate governance, and social. Now, the merge or the join that you can do with this type of table that I have performed here and ESG data, you can easily do it with some views that are already available in QA Direct. And the two that I've been using for the example that we see today are the view security mapping and security master. And if you are interested in finding out more about how these two views can be used, then please look at the MATLAB code that I'll be sending you after this webinar. The nice thing is that after having generated MATLAB code, you can then add into your live script specific controls. For example, a drop-down menu. This is going to be a control that people can use to interact with the code that you have developed. So, for example, here, adding an entry for environmental, and basically then when the person is going to select environmental, the query is automatically going to retrieve environmental data for all the companies that are listed in that market index. And that's pretty much what I've done here. As I showed you before, you can select one of the criteria that you want to use in your workflow. You can select the particular market index that you want on which you want to run the analysis, as well as the start date of your time series. And since these are going to be parameters or variables of your work, you simply add them in your query as variables. The ESG rating methodology, you find it in this piece of code. So it's following Refinitiv's methodology. Of course, then you can develop your own methodology, or you can simply stay with a numeric format of the overall ESG score. I have preferred in this case to make it a little bit more interactive and visual to work with ratings. What I'm going to do next, we have now retrieved ESG data as well as market data. What I'm going to do next, I'm going to first calculate the historical returns for each of the assets that we have in our universe. I'm going to annualize the returns as well. And then I'm going to calculate also the variance covariance matrix of this universe. Next thing you might want to do is to do some visualization. And here, having ESG information, you might consider as having an additional dimension to your data set. So one thing that I find very useful is to use bubble charts. This is a new plot that has been introduced recently in MATLAB. With a bubble chart, you can, say, visualize your data, the distribution of your data in 3 dimensions. One is the volatility, one is the return, and one is the ESG score. You see that the ESG score is here represented by the radius of the bubbles that are shown in this plot. Another nice thing is that whenever I'm gonna pass over one of these bubbles or more of these bubbles, I can display a series of information, such as the exact volatility as well as the exact historical return of that company, but also the ESG score here, in this case for Mitchells and Butler's 0.49. And I can do that for all the bubbles that I have in the universe. So this is very useful tool, in my opinion. The way you implement it in Matlab, it's also pretty straightforward. And the particular functionality is called data tip. So first you take the bubble chart object that you have created. You use one of its properties, which is called data tip template. And here you start adding the labels that you want to display in this data tip. So for example, volatility, historical return, ESG score, and so on. And once you have added the labels, you can use data tip text row to actually start adding also the numeric values that people would see when they're going to display these data tips. You see here also the colors are discriminating depending on the ESG rating. In blue, we have assets or companies with ESG rating A. In red, those with rating B, and so on. Another nice thing that you may want to explore is using callbacks for a higher interactivity with Matlab plots. In particular, when, for example, we start brushing one or more of the data points that we have in the plot, you may want to program it in such a way that actually something is going to happen. For example, the display of the time series that refers to that company or to those companies. So here I'm brushing 3 data points that I have in the ESG distribution bubble chart plot. And when I'm brushing them, I'm automatically displaying a so-called stacked plot, which is a time series plot for these 3 companies that I've selected. And this other plot as well provides you a lot of interactivity. You can pass over the single observations and see for each of the companies what was the price level on that particular date. Moving on, we can now start, after having done the visualization, we can start building our portfolio model. And I will start with a simple mean variance model. Probably most of you are already familiar with this. I'm going to minimize the covariance matrix that I've just calculated, subject to the constraint that the sum of the weights must equal 1 for a given level of portfolio target return. And you may also notice that here I'm not taking into account any ESG information. I'm going to start from this model, and then I'm going to build on top of this so that we are going to produce a portfolio that will be more diversified and better off in terms of ESG scores. To solve a simple mean variance portfolio optimization problem, you can use the Matlab portfolio object. You simply call the function portfolio. You calculate you pass the historical returns as well as the variance covariance matrix to the object that you have created. With set default constraints, I'm gonna tell to the optimizer that I want that the sum of the weights equal to 1. In this case, this means that no short selling is gonna be allowed. And then with the function estimate frontier by return, I will estimate the optimal allocation for the target return that in this case I've set equal to 10%. So starting from this, I'm gonna add also ESG information. And the next portfolio model in the next one, I'm gonna remove all the assets that have a lower ESG score. So again, using the portfolio object, setting the historical return and the variance covariance matrix. I'm not allowing any short selling. And then here you see with add groups, I'm adding a group constraint. And what I'm saying here to the object, I'm gonna limit the allocation of all the assets which have a ESG score equal to C to 15%. So no more than 50% will be allocated on assets which have a ESG score with rating C. For even worse ratings, for example, rating D, I'm going to completely exclude these assets. So I'm adding a constraint where the maximum allocation is equal to 0. And this is a simple exclusion, the ESG exclusion approach. But let's see how we can also build additional portfolios and still improving the ESG profile of the portfolio, but also producing a better diversified portfolio. In this case, I'm not going to use again the portfolio object that I just introduced you, but I'm going to use the problem-based approach that is available in MATLAB. It's a way of defining an optimization problem in the way you see here. So optim problem, it's going to set up an optimization problem. You can here define what is the sense of your optimization, either maximize or minimize, and then start adding the variables that are part of your optimization. In my case, there are simply the portfolio allocations, the weights of my portfolio, which are represented in this case by the variable X. And what I'm going to do in this approach, I will add a penalty term in the objective function. It's represented by a quite common index for measuring the concentration of a portfolio, the Herfindahl-Hirschman index. And this is simply given by the sum of the squared weights of the portfolio. But you might have noticed that here there is a parameter lambda that it's also part of this index. And in this portfolio optimization approach, I'm simply adding this term to the objective, which was the variance-covariance matrix of my initial problem. And what I can do now, I can emphasize or I can increase or decrease the diversification effect, which is being introduced by this term. Here, I've set it to 0.03. I've added also a slider. So depending on how much concentration one wants to add to its portfolio, you can increase or decrease this parameter. So really, this is the driver of the level of concentration or conversely of diversification of your portfolio. The objective function is defined here, simply adding the term that you see in this representation. We have the scalar lambda div, which is exactly this parameter lambda, and then I'm adding this term to the objective. Still, we need to add the other constraints. So, for example, the sum of the weights must equal 1, so that we have a long-only portfolio. And then we do the optimization for a given level of target return. Now, the nice thing of using the problem-based approach is that independently from the type of problem that we are dealing with, we don't really need to specify or to make use of a particular solver. Simply calling the function solve is automatically picking the correct solver or the most efficient solver for your portfolio, for your problem. Okay, so this is the first approach. And even though here we are adding a term for limiting the concentration of the portfolio, still we have not taken into account ESG information. So let's start from this and see how we can tilt the optimization towards a higher ESG score allocation. Well, it's pretty simple. The way I've done it is I've taken again what you saw before, the Herfindahl-Hirschman index. I've added it to the objective function, the variance-covariance matrix. And in this case, I've defined two coefficients lambda. The first coefficient is a coefficient only for assets which have a ESG rating C and D. And in this case, the lambda parameter has a higher value. For assets with a ESG rating A and B, I have a lambda parameter value which is lower. So the interpretation is that we are setting a penalty that is higher for assets or companies which have a lower ESG score. And of course, then these are parameters that one can select, can try out different values of the parameters in order then to achieve the optimal allocation depending on the type of mandate or ESG goal that one has. The last portfolio model that I'm introducing is another penalty term that I'm going to add to the objective function. And in this case, you see that in this term, the sigma variable is appearing. This is the volatility of the single. These are the volatilities of the single assets. Whereas before, we have been looking only at the concentration of the portfolio in terms of weights. You see here the variable that we took into account in this term was only the X variable. Here we are also using the information that relates to the volatility. So here we are more looking at the diversification in terms of risk of the portfolio. Same consideration as before. We are using the parameter lambda. We define different parameter levels depending on the ESG score. And this term is being added to the objective function. The constraints are being defined just like before. Sum of the X equal to 1, and we optimize for a certain target return. Let's have a look at the 5 portfolio models and how they have allocated among the assets and the companies that we have in the universe. What I have done, I have produced a bar chart. Okay, there might be some connectivity issues. Let me.
Valerio, switch off your video maybe. That might free up some bandwidth if you have connection problems.
Yeah. I'm gonna try to reload and see how it goes, hopefully. Okay, so these are the allocation results that I was about to show you. I've been using a Matlab bar chart in this case. And we see that we start from a mean variance portfolio model that is highly concentrated on a single asset. Almost 60% is being allocated on that on a single asset. In this case, an asset that has an ESG rating equal to D+. You see that things get better if we are excluding assets which have a lower ESG rating. It's a more diversified compared to the previous one, and also a portfolio that is better off in terms of ESG score. But you see that still this portfolio is quite highly concentrated in one asset, almost 40%, or on one rating. Almost 40% is invested on companies with rating B. You see that things get much better with the 3 other portfolio models. In the yellow bars that you see here in this plot, we have added a penalty term for improving and increasing the diversification of the portfolio, yet we were not looking at ESG information. In the pink one, we are adding also an additional penalty term for companies that have a lower ESG rating, C and D in this case. And then another model that is adding a penalty term in terms of risk in this case. And again, here we are adding a higher penalty for companies with rating C and D. I'm going to also introduce the concept of diversification ratio, which is defined in the following way. Diversification ratio is equal to 1 if you have a portfolio that is investing in a single stock only, whereas it has a value larger than 1 if it's a more diversified portfolio. The higher the value of this ratio, the more diversified your portfolio will be. So taking this metric into account, I've been looking at the diversification ratio and the overall ESG score of all these 5 portfolios. And you notice that the mean variance portfolio model has a low diversification ratio, 2.5, and also we're not very good in terms of ESG score, 0.33. Simply excluding from the universe ESG assets with lower ESG scores, yes, has improved our overall ESG score, but still we might not be very happy with the diversification ratio that we have achieved. And you notice that actually better results can be achieved with adding those penalty terms in the objective function. If we look, for example, at the 4th portfolio model, the one with a penalty with the Herfindahl-Hirschman index in the objective, we have a portfolio that is, compared to the second one, higher in terms of diversification ratio and also higher in terms of overall ESG score. The last model that we have added has actually a very high diversification ratio. We can now also have a look at the allocation in terms of single assets. So we are now at an single asset level. And we noticed, and this is something that we understood already, that the mean variance portfolio model was allocating highly on a single asset, 60% on a single asset. Things are getting better, excluding some of the ESG assets that we had in the portfolio. But actually, those that are more realistic portfolios are the ones that we have built with a penalty term in the objective function. Now, what I'm going to do next, I'm going to take the 5 portfolio models that we have built, and I'm going to use them for a backtesting, for simulating an investment strategy based on each of these 5 models. Matlab has added a particular useful feature, which is called Backtest Strategy. It's part of the financial toolbox. And basically, we are creating here for each of the models that I've just described, we are creating a strategy. Additional information, or past has name, value, pair, are related to the frequency of our rebalancing. What is the size of the calibration of the model? So in this case, we are going to look at a window that is going to comprehend at least 42 days, 2 months, and maximum 126 days. We will rebalance every 3 months, so 63 days in this case. And we can also add transaction cost. So we are adding a 0.1% fixed transaction cost, both buy and sell cost, for each transaction that is made according to each of these strategy. After having created an object for each of the strategy, I'm going to put them all together. And this object strategy, I will use them as a first input parameter for my backtest engine. To the backtest engine, there are additional options that you can add. For example, a risk-free rate that can be also taken into consideration. I've simply added one option here for the initial portfolio value. So what I'm going to display later on is a portfolio that will start growing from 1. To actually perform the backtest, I run the function run. I use the function run backtest. It's gonna take the backtest engine that I've just defined. Of course, we will need to pass as a second input parameter the actual market prices of each of the companies that we have in the universe. ESG information is gonna be being passed as a signal to the backtest engine, and then a start period. So this is typically being used as a warm-up period so that we avoid the look-ahead bias. Once we run that, we can then go on and visualize the final results. So we call the function summary after the backtest has been performed on the backtester object that we just created. And here we get a nice visualization of all the statistics that we see on the first column for each of the models that we have used in our backtest. So, for example, from the top to the bottom, we see the total return of the strategy, the Sharpe ratio, the volatility, and so on. And we actually see that adding those penalty terms, okay, it has improved diversification. It has done also very well in terms of overall volatility of our investment strategy. So you see that diversifying with the Herfindahl-Hirschman index has reduced the volatility. It's at 125%, as well as adding those terms and an additional penalty for lower ESG scores. We can now, of course, also visualize the final results of our backtest. And the way I do it is, again, with a Matlab plot. If I now, I'm going to show it larger. We see here how the 5 portfolio models have been performed throughout the backtest window, starting from the 1st January 2019 till end of September 2020. And we actually see how, if we now going to zoom in to this section, for example, that simply excluding, it's not the best option. We have seen it in terms of volatility, in terms of drawdown, and in terms of Sharpe ratio. And we also see it here from this line chart that actually the pink portfolio, for example, it's better off in terms of diversification, in terms of ESG score, compared to the portfolio that is simply excluding companies with a lower ESG score. The nice thing here is that you can interact with this plot, and you can also automatically see in the lower chart, in the lower plot, the data that refers to the ESG score for each of the 5 portfolio models. And the way I've done it, it's simply by calling the function link axis. So every interaction that you have with the first plot, it's going to be reflected, and automatically you will update the second plot as well. So I hope this was an interesting example on how you can actually add penalty terms and make use of Lagrange multipliers in your objective function for managing the diversification and improving the overall ESG score of your portfolio. There are other approaches that you can, of course, take. For example, you can add a penalty term for limiting the tracking error. Say, if you are trying to replicate a market index, so you can make use of such a term in the objective function for improving the ESG profile of your portfolio, but also keeping under control your tracking error. And another thing that one may do, and this is actually what is being proposed by the authors on which I've based this example upon, you can add multiple terms to the objective function so that you can emphasize or overweight one of the diversification measures that I've introduced, depending on the mandate that you need to comply to. So summarizing, I have introduced you to Database Explorer. We have interactively spoken to a cloud database, QA Direct in this case. it was really easy, and it was very much integrated in the overall workflow. You can automate the overall workflow by using Live Editor, and we have seen that using live controls, where we selected a different time horizon or a different market index, and then we would have retrieved different data directly from the database. And then we have built several portfolio models, both with the portfolio object, but especially with the problem-based approach, which makes things very easy, especially if you don't know what is the appropriate solver that you need to use, depending on the particular objective function or the particular constraints that you have. And then I have introduced you to the backtest engine that has been added recently in Matlab. And we could actually see how portfolios with such a penalty term in the objective function were performing better than simply excluding ESG assets from the universe. And with that, I will hand over again to Barnabas.
Thank you, Valerio. Very, very insightful. So I'm hoping that the positivity between a relationship between diversification and, of course, portfolio value and ESG are sort of demonstrated with this, and looking forward to maybe host similar webinars that are discussing maybe other aspects, like what type of ESG related case study would you like to see in the future events, kind of aspects like ESG fund construction, or ESG reporting or ESG scoring for unstructured data. If you could just submit your views quickly, we head to the Q&A, then that would also provide us very good insights how we should create a good sequence of this presentation, if you find that useful. Going to the next one. Oh, okay, look at that. ESG index fund construction and ESG scoring from unstructured data. Anything directly, Magda, from the QA panel? Is there any direct questions to us?
Hi, yes, we had a question regarding the recording to be sent, and I do confirm everything, all the material, including the presentation and the recording of today's session, will be sent out by the end of the week, preferably tomorrow. So we will have all of what you could have seen today.
Thank you. Look, just Valerio, just maybe one or two from my side. Of course, you were when you did the backtesting, you were fixing the costs for transactions. So is it possible to do the same? So does the support does the backtest engine support the variable cost as well?
Yes, it does. I have passed it in this example as a single constant value, but actually you can pass it also as a function handle. So you would in MATLAB write a function that is modeling the transaction costs of your model, and directly the backtest strategy is going to take that into account.
Super, thank you. And just somewhat selfishly, is there a way to export the data back to the database directly from MATLAB?
Yes, there is. I mean, Database Explorer is part of a toolbox that is called Database Toolbox. And there you will find features and functionalities that allow you also to write back data, for example, that you have been developing in MATLAB, that you have calculated in MATLAB. One of these is, for example, for an SQL database, it's the function SQL write. So you would specify the variable that you want to write back in the database, as well as the table in the database, and then you would directly call that function.
Super, thank you. And what would be the recommended workflow if I want to retrieve large data sets from the database itself?
So yeah, that a little bit depends on the size of the data. I mean, large data can be considered as big data or not. If you are dealing with data that you still can save in memory, I recommend you to use those features that I've introduced today. together with parallel computing. So you can actually split the SQL query into separate processes and parallelize the whole workflow. If you are actually working with a very, very large data set, so we are going in the direction of big data, you can create a so-called Matlab data store. And particular for databases, you would use database data store. And this allows you to work with the data that are contained in a database out of memory. So without actually retrieving the data, you can still run your analysis on that data.
Super, thank you very much. It was great having you here. I think we learned quite many things today. Of course, something more about ESG data and maybe what would be the ones that you include into your analysis, how to easily manage a big database and how to join different tables. And of course, very importantly, how to use the different analytical tools that are provided by Matlab. When building these kind of portfolios and building these kind of criteria. If there is no further questions, then thank you very much for everybody for the attendance, and of course looking forward to continue this session. Your insights and responses were very, very useful, and there is going to be follow-up material sent out to the attendees with all the relevant information included. And as Magda just highlighted at the very beginning, there is going to be a pop-up window. If you can fill that in, that would be very useful. For now, thank you very much, Valerio. Thank you very much, Magda. And thank you very much, everybody who attended the call. And I wish you a great rest of the day.
Thank you for joining us. Have a good rest of your day.